South Africa. What are you mid? What is that? What are you guys even saying? Like, what are you saying? Hi, Tracy. That's hot.
Okay, friends, so now we are going to ready to talk about the factors that affect CDS pricing. A lot of this information should already be, you should be already familiar because we covered it in the prior reading on credit analysis models. So just one LOS in this module, explain the principles underlying and factors that influence market pricing of CDS. All right, so once again, a refresher from prior reading, probability of default is the likelihood of default in any given period by the reference entity. It is simply equal to the hazard rate times probability of survival from the prior period. So this is what you have already seen. Hazard rate is a conditional probability of default, which is basically default if probability of default if default has not occurred in the prior period. And probability of survival is 1 minus the hazard rate raised to t. All of this is exactly as we already talked about in credit analysis models. All right, so now we'll talk about a quick example from the curriculum. Assume that the company's hazard rate is 8% per year or 2% per quarter. Now there is a protection seller who has sold 5-year protection, and premiums are paid quarterly over the next 5 years. What is the probability of survival for the first quarter? Now, if the hazard rate is 2%, for the first period, it is 1 minus percent raised to 1, and it is simply 98%. Now, this question is a little unnecessarily adds complexity, so I'll explain. So again, the same information, 8% per year or 2% per quarter. Now the question is, what is the conditional probability of survival for the second quarter? Now, if it is regular probability of survival, so if I take away the conditional, it is 0.98 raised to 2. But that's what we have learned. Probability of survival for period 2 is equal to the probability of survival raised to 2, or 1 minus the hazard rate raised to 2. But this is not asking for probability of survival, it's asking for conditional probability. So conditional probability simply says Just remember again, the probability of default was decreasing over time, while the hazard rate was the same. Hazard rate was a conditional probability of default. Well, similarly, for probability of survival, it decreases over time, but the conditional probability of survival remains constant, remains the same. So in this case, even for period 2, it is 98%. The reasoning is conditional means given we already know that the company has survived in quarter 1, what is the probability of survival in quarter 2? Well, as opposed to ex ante, we don't know whether the company is going to survive in quarter 1. If it is ex ante, we would say 0.98 raised to 2. But if you already know what has occurred in period 1, quarter 1, then our probability for second quarter remains at that 98%. So, and then third quarter would remain the conditional probability of survival will still remain at 98%. Now, assume a company's hazard rate is constant, again, 8% per year, 2% per quarter, same 5-year CDS selling protection. And what is the probability of survival through second quarter? Now it is not asking for conditional probability, and it is simply 98% raised to 2 or 96.04%. So as you can see, the probability of survival will decrease over time. Now, what is the probability of default? Well, 1 minus 96.04%, which is 3.96. That is not the probability of default in the second quarter. It is the probability of default in first or second quarter. Now, the concept of upfront payment, remember we said because the coupon rate and the CDS premium or CDS spread is different, or credit spread is different, there is one party that is going to be disadvantaged, and that party will receive upfront payment. Now, think of it as on an ex ante basis, what is the cash flows involved for the protection leg? So protection leg is cash flows from seller, and premium leg is cash flows from protection buyer. The buyer makes the periodic premium payments, and the seller pays the buyer in the event of a default. So the cash flow from the buyer as well as cash flow from seller both are on estimated basis, on an ex ante basis. Now you would say 1 minute, buyer's cash flows are known, not necessarily. The buyer's cash flows are also not known, are also uncertain because we don't know when the swap settles or the swap terminates. Meaning, if default occurs, remember the swap terminates, so the protection buyer will not continue making those payments beyond that settlement date, beyond that default date. So on an ex ante basis, we form expectation of more cash flows from both parties, and they should be equal. In other words, your policy premium should be consistent with the risk of the policy. Now, protection leg is again the cash flows that is paid by the protection seller, and premium leg is the coupon payment made by the protection buyer. You want to set that. But We know that the coupon is not the same as the CDS spread, so we said the present value of the difference is paid upfront by the party that is advantaged by the arrangement, and that is simply equal to CDS spread minus coupon times duration. Now, if CDS spread is greater than coupon, protection buyer is benefiting, making lower coupon payments, and therefore your protection buyer pays. But if this value turns out to be negative, CDS spread is less than the coupon, the protection buyer is making a negative payment, meaning they're receiving upfront payment. This upfront payment is in percentage, and that is why I'm not multiplying by the notional principal. Now you say, well, remember earlier we talked about present value. Here we are multiplying by duration, and that is that is exactly what is occurring. This approximation says if you multiply the difference by the duration, you are basically getting to the present value as an approximation. All right. So think of duration as a present value operator. All right. Now the price of a CDS is a quoted price of a CDS is simply 100 minus the upfront premium. And obviously, if the CDS spread is greater, the price greater than the coupon, the price will be more. Price will be less than 100. And if it's conversely, where coupon is lower, coupon is higher than CDS spread, then the upfront premium will be negative, and the price will be more than 100. Now, after inception, so for example, based on the current credit spread of a bond of 5%, you undertake a protection buyer position for $10 million of protection. Based on 5% current credit spread. Coupon is not relevant right now. We are assuming that either you are paying the 5% or you made the adjustment in upfront premium. Everything is based on that 5% current credit spread on that security. Subsequently, after the inception of the swap, supposing the market credit spread on that specific reference entity widens from 5% to, let's say, 6%. So the change in spread is positive. Now, who benefits when the change in spread is positive? The buyer, the protection buyer. Remember, protection buyer is the short party. They benefit when things go back. They are speculating that that credit spread is going to widen. They have locked in a fixed 5% during the length of the swap. So whenever the swap spread, whenever the credit spread widens in the market on the reference obligation, the protection buyer benefits, and the benefit amount is simply the change in spread times duration times notional principal. This is a dollar amount. If it is just a percentage, then it will be change in spread times duration. Now, the duration that we have talked about all the time is duration of CDS, not duration of the underlying reference obligation. So keep that in mind. Duration we are talking about, even in the previous slide when I talked about duration as a present value operator, it was still referring to duration of the CDS. Now, you say, well, wait a minute, and this is a common concern or source of confusion for candidates, and that is, how does the protection buyer benefit? You say that when the spread widens and the protection buyer benefits. Well, and let's say there is no default. Well, if there is no default, the policy doesn't pay off. And so how does the protection buyer benefit? They are still paying that 5% premium, but they have not received any money from the protection seller. The protection buyer can monetize it by entering into an offsetting swap, or basically selling the existing swap in the market. So how does that work? If you enter into an offsetting swap, the current market rate for the offsetting swap is 6%. So you bought protection at 5% and you're selling protection at 6%. And every quarter, you are just collecting whatever the difference is on a quarterly basis. So 1% difference, you're getting 1/4% of the notional every quarter as your net profit. So that's how a protection buyer can monetize their position by undertaking an offsetting transaction. Now, assume a high yield company's 10-year credit spread is 600 basis points, and the duration of the CDS is given to you as 8 years. What is the approximate upfront premium required if the coupon is 5%? So now, the credit spread is higher than the coupon by 100 basis point or 1%. Multiply that by 8 years, so you get 8%. And who is going to make that upfront payment? The protection buyer, because they are paying less in coupon than the credit spread. Monetize their position by undertaking an offsetting transaction. Now, assume a high yield company's 10-year credit spread is 600 basis points, and the duration of the CDS is given to you as 8 years. What is the approximate upfront premium required by 100 the protecting coupon percent or 100 basis points? Multiple, you get 8% of the notional. And that would be paid again by the protection buyer. Now, second example is, imagine that an investor sold 5-year protection on an investment grade company, had to pay 2% upfront. Premium to the buyer of the protection company's credit is what we are calculating. Multiply this difference, that's negative 2%. Remember our upfront premium formula that we had? is by the buyer. Here it is the upfront 2%. Times you can verify is paying 1 simply equal to premium upfront premium is negative 2%, and so therefore the price should be 102. Now, an investor buys $10 million of 5-year protection. CDS contract has a duration of 4 years. Credit spread was originally 500 basis point, widens to 300, so change is equal to 300 basis points in increase, so change is positive. Now, does the credit protection buyer benefit or lose from the change in spread? No calculations are required for answering that question. The protection buyer will benefit when the spread widens because they are short the credit exposure. So
yeah, I got that wrong.
when the credit quality deteriorates, the protection buyer is benefiting. They will be in the money on that swap. So the protection buyer benefit in this scenario, in this example. All right. So again, so far we did not calculate. Now we will calculate. Now we are asked to basically calculate the gesture. Again, notional is given to us as 10 million, and the spread is widened by 300 basis point, duration of 4 years. So 4 years times 3 basis points. the notional principal of 10 million, and 12% of 10 million is 1.2 million. That is the profit to the protection buyer. They have not monetized it yet, but that is the paper profit for the protection buyer. Now, what is the change in this price of the CDS? The change in price is 12%, simply the 300 basis points times the duration given to us directly.
How many hours do I aim for in the weekend? I try for 6 to 8. I can usually do 4 in the morning, and I can do 4 in the afternoon. I can't really do more because then I'm tired. But I can do questions. So I think if it's just reading or getting new material, then I can do like 6 to 8 on a weekend. But I can push more questions once I'm comfortable with the material. It's just that right now I'm doing reading the material, a master class, which is a video on the material, and then questions on that specific material. So I'm not at a push questions phase. But once I get to push questions phase, which is the exam phase, I'm gonna be able to do like maybe 10 hours on a weekend, like on a day per weekend. Because questions you do, you mark, and then you do corrections. So when you're feeling tired, you can just do corrections. So I can do and mark, do and mark, do and mark. And then when I feel like I'm tired, I can just do corrections. But yeah, I can do 6, 8. If you do more than that, then you're not as effective. So I don't want to waste my time with that. I'd rather, go out or do chores, like make food, iron, do the laundry when I'm tired, rather than pretend to be working, basically. During the week when I've got 9 to 5. Okay, I study in the morning. I get into work 6:30. So I work up until 7:38. That's like an hour and a half. Then after work, I study from about 5:30 to 6:30. That's another hour. So I do 2.5 hours, 3 hours at work. Then when I come back, I do 2 to 3 hours here. So that's 5 a day. I do Monday, Tuesday, Wednesday, Thursday or Friday. So 4 days. Then I do Saturday, Sunday. I take one day off during the week, and then Saturday, Sunday, like I said, I do 6 to 8 hours each. hot. That's my study alarm, but I'm already in it. I've been in it for an hour, so I think 9:30 I'm gonna go. I still need to iron my clothes for tomorrow.
All right, friends, we're going to wrap up this reading with the third module, which basically goes over using CDS to execute either an arbitrage transaction or a transaction that would benefit from a specific expectation about the future change in credit spreads. Two LOSs, let's talk about some descriptive traits. One is, first, general principle that short party benefits when things get worse. In this context, worse means increasing credit spread. So increasing credit spread benefits the protection buyer, which is the short party. Conversely, long party benefits when things get better, meaning spreads narrow, meaning the protection seller benefits. The long party is the protection seller. All right. In a naked CDS, an investor is basically speculating on changes only in credit spread of a specific entity in the future. We are focusing only on credit risk, not on interest rate risk. So just the credit risk component. And in a naked CDS, the investor is betting on changes in the credit spread. So if you're expecting spreads to widen, you would buy protection. If you're expecting credit spread to narrow, you sell protection. Now, in a long-short trade, you are buying protection on one entity and selling protection on another entity. You are hoping that the yields move in your favor. Sorry, you're hoping that the credit spreads move in your favor. Wherever you are long, meaning you sold protection, you hope that the spread narrows relative to the narrowing of the spread on the short side. Or if the spreads are widening, the one that you're long, you expect it to widen less as compared to the one you're short. Once again, long is the seller, short is the buyer of protection. In a curve trade is a long-short trade also, but investor is buying, selling protection on the same reference entity, and this is basically a term structure trade for a specific entity. So if you are expecting an upward sloping, so it is credit spread for company A, and this is maturity. If you have an upward sloping credit spread curve, and if you are expecting it to flatten, and we are going to basically, whenever you see upward sloping flattening, you're assuming that the long end is changing, not the short end. All right, so the long end is decreasing, the spreads are narrowing.
Yeah.
And who benefits when things get better? If spread change in spread,
the put seller or the protection seller.
Spreads are narrowing. So in that case, what you do is you buy protection at the short end. You buy protection in the short maturity.
And then you sell
remember,
protection
buyer
in the
expects
long.
things to worsen. It is not worsening. In fact, it's getting better. But you're selling protection in the long maturity. Because the spread is changing to be negative, things are getting better, you sell protection. You want to go long on the long end of the CDS tenor or CDS time period. All right. An investor who believes that the short-term outlook is better than the long-term, exactly opposite. In the short term, spreads are going to narrow or remain static. Long-term spreads are going to get worse. It is called a curve steepening trade. In that case, you're doing exact opposite. Things are going to get better. You sell protection. Things are going to get worse.
You buy protection.
You go short. So in this case, you are going short the long term and long the short term. Basis trade is an arbitrage transaction. And in a basis trade, what you're doing is you're basically exploiting mispricing in the CDS market relative to the cash market, so bond market. So in the bond market, say for example, company A bond credit spread is 3%, and in the CDS market, the spread is quoted as 2%. Well, you want to buy low and sell high, and higher spread means lower price. So you buy in the bond market at 3% credit spread. So you buy the bond and you short in the CDS market. And now keep in mind, short means buying protection. So you buy the bond and buy protection. In effect, you are getting 1%. The difference between the two is 1%. You're getting 1% for taking no credit risk, right? You're getting 1% credit spread for taking no credit risk, because when you buy protection, you're taking your credit risk and making somebody else's problem. So that is mispricing. If there is, you can take advantage of it, and that is an arbitrage transaction. Alternatively, you can buy and sell debt of the same entity in the bond market only, not entering the CDS market. So you may have bond A, same company. Bond A, again, credit spread is 3%. CDS spread is 2%. And bond B is credit spread is 2%, CDS spread is 3%. So bond A is offering a higher credit spread relative to what it should be as priced by the CDS market. So you buy bond A. Conversely, bond B is giving you a lousy credit spread, and therefore you sell bond B. You are not entering into the swap anymore. You are just entering into the bond market and undertaking a long-short transaction based on the information gathered from the CDS market. Now, synthetic CDO. So CDO is a collateralized debt obligation. So think of it as a pool of high credit risky securities, very high credit risky securities. Think of distressed debt, junk bonds, and so forth. So you are buying these securities at pennies on the dollar, right? And let's say you buy 10 million worth, or let's say it's 100 million par of this distressed debt securities, and then you have investors who put in that $10 million. You could use that money and go out and buy $100 million par value of this distressed bonds. That would be cash CDO. Now, the expectation is because of the diversification in that pool of different debt securities, not all of them are going to go bust, and so hopefully your return will be higher than or your return will be more than justified by the $10 million investment. That is a cash CDO. Alternatively, take the same 10 million and put it in treasuries, and then sell protection for 100 million notional. So you have created what is called as a synthetic CDO. You are taking the credit risk. You're taking the credit risk by selling protection. And you are long credit risk. Remember, seller of CDS, seller of protection is long credit risk. So you're taking the long credit risk, but not in the bond market. It is kind of expensive to go out and buy these distressed debt securities individually. So you immediately are able to get that same exposure via the CDS, and that's why it's called synthetic CDO. So if it is, if the pricing of synthetic is different than the cash, you can probably make an arbitrage profit, sell one and buy, sell the more expensive one and buy the cheaper one. Okay, so an investor owns some intermediate-term bonds issued by a company and is concerned about risk of near-term default.
So short-term.
So near-term, the investor is
Worried.
concerned about the risk.
Yeah.
But in the long term, the investor is okay. He's not concerned. The company's 2-year CDS currently trades at 350 basis point, and 4-year CDS is 600 basis point. You're asked to describe a potential
curve trade. Okay, so he's worried about short term. Let me just draw the curve. So we assume it's upward sloping. He's worried about short term, but he's not worried about near term. So he thinks near term there's going to be a curve flattener. So negative, short term, positive, long term. Short term will get worse. Long term will get better. So what he wants to do is he wants to sell protection in the long term, and he wants to buy protection in the short term. Yeah.
The curve rate. So wherever you think the credit quality is okay, you are willing to be selling protection. Wherever you're concerned about the credit quality, you buy protection. So in this case, the investor is anticipating flattening of the curve. So what do? Again, buy protection for the short end, which is near term.
Yeah.
For 2-year CDS and sell protection for the 4-year CDS. Now we'll look at an arbitrage transaction, bond versus CDS market. So investor wants to be long the credit risk of a given company. So you're given specifically you want to be long. The bond is currently yielding 6% and matures in 5 years. comparable 5-year CD contract, comparable 5-year CDS contract. Is generating a spread of 3.25%. So CDS spread is 3.25%. Now, investor can borrow at MRR, which is 2.5%. You're asked to calculate the bond's credit spread. So if you're not doing any trades, just calculating the credit spread available on the bond, which is simply the yield on the bond minus the MRR, which is 3.5%. Now we're going to calculate a profit on a trade that allows us to exploit the mispricing in the market. Now, bonds credit spread, we calculated 3.5%. CDS spread is 3.25%. So how will you exploit this using a basis trade?
Long bond,
The bond
short
is offering a higher credit
CDS.
spread, you buy the bond.
Yeah.
So I'm going to assume you borrow at 2.5%, buy the bond, and buy credit protection. So you're buying the bond, you're shorting the CDS. Short means buy protection, okay? So when you buy bond, so net return is 6% yield on the bond, minus 2.5% that you pay for your borrowing cost, and minus 3.25%, excuse me, that you pay as CDS premium. So you get net return of 0.25%. Basis point. And now one of two things could happen. Either there is default or no default. If there is no default,
You're good.
then this 0.25% continues for a 5-year period, the bond's maturity. If there is a default, then what happens is you get the payoff from the CDS seller, and you take that payoff and repay your loan. You get your full money back and you repay your loan, and you are back to, so the period of time that you are able to enjoy that 0.25% spread is yours to keep. So that is your basis trade. And we basically can determine that as the difference between the bond's credit spread and the CDS spread. So you go long the bond and short the CDS. Short means buying
Protection.
in the CDS market. So that is your using a basis trade in the bond market when the credit spread differs from the CDS market.
Okay, I've got a quiz with 6 questions. Jamshed Banaji, CFA, manages a $400 million bond portfolio for a large public pension fund. Banaji is concerned about volatility in the credit markets and expects credit spreads to widen. In the short term, but revert back to current levels over the long term. Banaji has flagged two of his holdings for further scrutiny, IDG Corp and Zeta Corp. Portfolio currently has 10 million par value, 6% 10-year senior bonds. Because he's concerned about their risk, he enters into a credit default swap as a protection buyer. He also selects a 5-year senior CDS for IDG, the coupon rate of 5 and duration of 4. He has a yield to maturity of 6.5. MMR yield curve is flat at 2%. That means he borrows at 2%. He's also concerned about the Zeta Corp bonds that he holds. They're planning to pursue a recapitalization plan that involves a large stock buyback program financed by debt. So, Zalta, that's a leveraged buyout, equals increase in debt levels, equals you want to buy protection, CDS, and you want to buy the shares. Okay, let's go look at the questions. Question 1. The most appropriate strategy for him, given his expectation about changing credit spreads, is A, credit curve trade, selling protection in the short term and purchasing protection in the long term. I said buy protection in the short term. No. So credit curve trade, buying protection in the short term and selling protection in the long term. Yes, B. 2. At inception of the CDS for IDG bonds, Banaji is most likely to receive a premium, pay a premium or receive a premium, and then they give you amount. So for IDG bonds, what is the premium going to be? So premium is equals to CDS spread minus CDS coupon times duration. Oh, it's so hot. What's the CDS of the spread? Par value 6%, 10-year unsecured. Is concerned about that. To solve the credit default buyer. Okay, selects 5-year senior CDS for the coupon rate of 5%. So what's the spread? The bonds have a yield to maturity of 6.5%. They're paying par value of 6%, coupon rate of 5%. So the spread is, I think it's 0.5%. And it must be in bips. So it's going to be 50 bips minus the CDO's coupon. It's 5%. So that's going to be 500 times the duration. That's 5. So I said CDS spread minus CDS coupon. So it's going to be minus 450 times 5 minus 2250. I don't feel confident about my CDS spread. Okay, let's see. That's times 10 million. Let's divide by 100. 10. That's, yeah, I mean, he's buying protection, so he pays a premium, but of how much? I said pay a premium of 300,000, but my amount is not there. Yeah. Let's see. Okay, question 3. For this question, only suppose that 6 months after the inception of the swap, they declare bankruptcy. Figure 1 shows that the market price of the bonds after filing for bankruptcy. So 9.5%, 6% senior secured. Oh, this is how much he's going to likely recover. If he has a choice of settlement procedure, he's most likely to choose. He bought protection and now they've defaulted. A physical settlement, a cash settlement, and the payoff of the 6 million, a cash settlement in the Okay, so he bought protection. Now he needs to find the cheapest to deliver. So is it 9.5%, 9.5 years, 6 years, senior secured at 45% of par, 5 year, 5% unsecured? What is he matching? Senior unsecured, 10 year, senior unsecured, 40% of par, senior unsecured, 9.5, 45% of par. Cheapest to deliver, this is 5 year, 6% subordinated unsecured. He needs senior unsecured, that's the cheapest. That's 40% of par. So I want to say 0.4 times the 10 million. I think so he's going to need to pay out 4 million. So it's going to get paid out 10 million minus the 4 million. So this is 3. So he's going to get 10M because he's got protection minus 4M. That's cheapest to deliver. 6M, therefore B. Yeah, okay. C or 4. Which of the following statements about hazard rate is most accurate? Hazard rate is the probability of default given that the default has already occurred in the previous period. No. Affects both the premium leg as well as the protection leg. Is higher for higher loss given default. I think B affects both the premium legs as well as the protection leg. The most appropriate strategy for him in regard to Zeta Corp, those are the ones with the leveraged buyout, would be to buy stock and buy CDS protection. What did I say? Yeah, I'd say buy protection and the CDS. So, yeah, so A. The statement credit spreads are positively related to loss given default and to hazard rates is correct. Yeah, 6, it's correct. I got 83. I got number 2 wrong. So the premium I got wrong. He would receive a premium of that. Credit spread is yield minus MRR, 4.5. Oh, I got the credit spread wrong. So that's 4.5 minus CDS coupon times duration times notional period. Oh. Let's see. You need to count above benchmark. Okay, that's fine. Well, yep, I know that one. Yep. You're just matching the type of instrument. Yep. Let me get this on hazard rate. Oh, it is so hot. Hi, Tracy. Oh gosh. What? When I tell you all of the women in me are tired. I'm finished with Shiza notes. Oh, CDS features and terms. I thought I'd done that. I'm done with the quizzes. There's another masterclass. I thought I just did this. Hey. I did this, Jay.
All right, friends, welcome back, and we are now ready to talk about the reading on credit defaults dies, then the policy pays off. This is based on what entities.
I did
So there are
this.
some examples. We have $300 on a $1,000 par value bond. The original notional, $4 million is the notional. So there are protections to the protection seller. In return, there is a template that is created by ISDA. In some cases, on just one TDS recovery, here refers to settlement or physical settlement, they end up with 10 notional settlement amount.
No, I already did this. See? So there's quizzes. That's all that's left. Otherwise, I'm done. Yeah, I'm done with fixed income. Yeah, I'm gonna start with financial statement analysis. Let me look at my performance tracker. I think I want to iron now because I'm tired. I'm on 28%. Yeah, I was hoping to be at about 30 by now. But yeah. Maybe I can do a question bank. Don't think that gets me to 30 though. 34 questions. I can't. Yeah, there's 2 quizzes. I'm not gonna get to it. I can do financial statements analysis. I can do the first model, which is just classifications. But yeah, that's the next topic, I guess. We're doing financial statement analysis. I think I'm just gonna write the topic. I'm so tired. And I'm hot more than anything. I'm not tired because I was studying, because I didn't study long today, but I feel hot. So I think I would rather iron and watch TV before it gets late, so that I can be nice and fresh for tomorrow. Okay, I'm gonna end the what's her name here. Thanks for joining.